On a single day in May 2023, Nvidia's stock price rocketed 24%, adding about $184 billion to its market value. In an instant, a chipmaker long known for gaming GPUs was propelled into the trillion-dollar club, trailing only tech giants like Apple, Microsoft, Alphabet, and Amazon. Investors cheered Nvidia as the backbone of a new AI revolution, bidding its shares up over 700% in 5 years. The company's latest earnings showed staggering growth, a quarterly revenue of $18.1 billion, nearly tripling from a year ago. It seems Nvidia can do no wrong. But behind the euphoria lurks a nagging question. Is Nvidia's trillion-dollar rise built on real fundamentals, or just belief? The stakes are immense. Nvidia now towers with a market capitalization over $1 trillion, even surpassing $4.6 trillion at one point in late 2025. That valuation made it worth more than AMD, Intel, ARM, and Broadcom combined. Such a swift ascent has few precedents in stock market history. In this video, we'll dissect both sides. The compelling bull case that paints Nvidia as the indispensable engine of the AI era, and the bear case warning that its stock may be priced beyond perfection. So, how did Nvidia capture the market's imagination? What makes believers so confident, and skeptics so concerned? Let's dive into the evidence, starting with why so many insist that all roads in AI lead to Nvidia. Nvidia's bullish supporters argue that its dominance in the AI hardware landscape is unlike anything we've seen before. The numbers speak for themselves. As of 2025, Nvidia commands over 80% of the AI-specific chip market and an eye-popping 95% share in data center AI processors. In traditional graphics processors, it's similarly unrivaled. Around 92 to 94% of discrete GPU shipments belong to Nvidia. This near monopoly in cutting-edge silicon gives Nvidia immense pricing power and a degree of control that few tech companies ever achieve. It's not just the chips. It's the software ecosystem binding customers to Nvidia. The company's CUDA software platform has become the de facto language of AI developers, creating a moat that bulls describe as impenetrable. Over 90% of AI developers rely on Nvidia's CUDA libraries and tools. Switching away isn't just difficult, it could mean abandoning years of code and expertise. This ecosystem lock-in means that even if rivals produce comparable chips, customers remain glued to Nvidia's platform. Beyond market share, Nvidia has methodically built a full-stack strategy. It sells not only GPUs, but also the networking gear, InfiniBand, NVLink, and software frameworks needed to stand up entire AI factories. In essence, Nvidia is transforming from a component supplier into an end-to-end AI infrastructure company. This has led some to dub it AI's full-stack architect, underpinning everything from model training in data centers to deployment in robots and cars. The company's latest chips, like the Hopper H200 and Blackwell GPUs, are often sold as part of Nvidia's own DGX systems or SuperPod supercomputers, further cementing its comprehensive grip on customers. Each layer of this stack, from silicon to software, feeds into the next, creating synergy and high switching costs. Another pillar of the bull case is sheer demand, and not just from Silicon Valley. In what CEO Jensen Huang calls the coming wave of sovereign AI, entire nations are racing to build their own AI supercomputers. Governments and sovereign funds are pouring billions into AI projects, and Nvidia is often the first call on their list. A striking example came in 2025 when Saudi Arabia's public investment fund launched Humane, an initiative to build giant AI factories powered by Nvidia chips. In a single deal, Saudi Arabia ordered 18,000 of Nvidia's latest GPUs, a purchase analysts estimate at up to $20 billion in value. Nvidia execs half-jokingly refer to this trend as sovereign AI FOMO, as governments fear missing out on the AI revolution. The result? Even more insatiable demand for Nvidia's hardware. Jensen Huang captured it succinctly on an earnings call, noting that the next wave is coming: agentic AI for enterprise, physical AI for robotics, and sovereign AI as different regions build out AI for their own ecosystems. In other words, every major country and tech giant now needs what Nvidia is selling. This unprecedented appetite shows up in Nvidia's financial results and forecasts. In late 2024, Morgan Stanley reported that Nvidia's entire 2025 production of AI chips had already sold out in advance. Think about that. Before the year even began, every chip coming off TSMC's lines for Nvidia had a buyer waiting. Such was the scramble for AI hardware after the breakout of generative AI models like ChatGPT. Nvidia's data center revenue, mostly AI accelerators, exploded, making up roughly 78% of its $60+ billion in sales for 2023. Overall company revenue surged from just under $7 billion in 2017 to about $27 billion in 2022, and then jumped again to over $60 billion by 2023. Extraordinary growth for a firm of its size. Profitability climbed in tandem. In the 2022 fiscal year, Nvidia earned nearly $10 billion net on $27 billion revenue, and recent quarters suggest profits are rising exponentially with the AI boom. The company now generates around $1.7 million in revenue per employee, reflecting both its pricing power and its fabless model, outsourcing chip fabrication. Few businesses on Earth operate at that level of efficiency. Fundamentally, bulls argue that Nvidia isn't just selling chips, it's selling the pickaxes of the AI gold rush. Every major tech player, from cloud providers like Microsoft and Google to startups building the next chatbot, needs high-end GPUs to train and run AI models. Corporate spending on AI is hitting a frenzy. In 2025, tech giants were expected to spend $330 billion on capital expenditures, much of it for AI data centers. Microsoft alone ramped its quarterly capital expenditures to a record $30 billion to alleviate AI capacity shortages, while Google boosted its annual capital expenditures budget to $85 billion, a $10 billion jump, to keep up with AI demand. This surge in investment is directly feeding Nvidia's sales. As one analyst quipped, all roads in AI lead to Nvidia. The company's chips power ChatGPT, Bing's AI, Google's Bard, Meta's recommendation engines, and countless other services. With such entrenched dominance, the narrative is that Nvidia has become to AI what Standard Oil was to oil over a century ago. In fact, a common refrain is that semiconductors are the oil of the 21st century, essential to every facet of the modern economy, and Nvidia currently pumps the highest grade fuel. Jensen Huang himself is one of Nvidia's biggest assets in the bull's eyes. A charismatic founder-CEO often clad in his trademark leather jacket, Huang has evangelized AI with almost prophetic zeal. "In the last 40 years, nothing has been this big," he said of artificial intelligence. "It's bigger than PC, it's bigger than mobile, and it's going to be bigger than the internet, by far." Such bold statements galvanize believers who see Huang as a visionary akin to Steve Jobs. More importantly, Huang has a track record of being right. Nvidia bet early and big on AI acceleration when it wasn't obvious, and that gamble is now paying off spectacularly. Under his leadership, Nvidia also moved upstream into software, like AI frameworks and digital simulation platforms, and downstream into services, like cloud partnerships and AI as a platform offerings. This means Nvidia can capture more value per customer. A company or government might buy thousands of GPUs, then also pay Nvidia for software licenses, and even rely on Nvidia's engineers for expertise to stand up their AI systems. No other competitor offers this full-stack solution at comparable scale. Finally, consider the scarcity and pricing dynamic. In mid-2023, as the AI craze took off, there were widespread reports of shortages. Startups and research labs literally couldn't get their hands on Nvidia's top-tier H100 chips, which were selling on secondary markets for tens of thousands of dollars each. Some large cloud firms began rationing GPUs for their customers. This scarcity enabled Nvidia to raise prices. The H100 costs significantly more than its predecessor A100, and enjoy fat margins. One estimate suggested that $1 trillion worth of existing data center equipment will need to be replaced by AI-focused hardware in the coming years. If that's even partially true, it implies an enormous upgrade cycle that Nvidia is uniquely positioned to capitalize on. Huang likens the situation to a once-in-a-generation inflection point. Data centers built for general-purpose computing are being refitted for AI, much like factories once electrified their machinery. To bulls, this isn't just hype. It's already showing up in Nvidia's order books and earnings. Despite Nvidia's breathtaking execution, skeptics say the stock still bakes in near-perfect outcomes. By late 2025, its market value briefly touched about $4.6 to $4.7 trillion, the most on Earth. Even after profits exploded, the trailing multiples stayed rich, roughly a PE in the low 50s and a price to sales near the high 20s. For context, mega-cap peers typically trade at single-digit to low-teens sales multiples. And during the first AI surge, Nvidia's ratios stretched far further. A triple-digit trailing PE at points in 2023, and price to sales that pressed into the low to mid-30s as revenue lagged the hype. Yes, today's earnings have caught up, but the bar keeps rising. At these levels, the market isn't paying for greatness, it's paying for flawless. History shows that sustaining such extremes is rare, and when expectations are this tight, even a small miss or guidance wobble can trigger outsized drawdowns. Investors know the script by now. Understood. That's the paradox of dominance in late 2025. Nvidia's scale and pace are unprecedented, yet the valuation leaves little room for error, magnifying every headline about supply, competition, or export rules into a referendum on the thesis. The disconnect between Nvidia's market cap and its revenue is a key concern. Picture a simple line graph. One line shows Nvidia's annual sales, the other, its market value. In recent years, the market value line has shot up like a rocket, far outpacing the revenue line. Nvidia's annual revenue more than doubled from 2020 to 2022, which is excellent, but its stock price rose roughly eightfold in the same period. By late 2023, Nvidia's market cap was about $1.16 trillion, while its yearly revenue was approximately $27 billion. That's a gap of more than 40 to 1. Even accounting for the 2023 sales jump to approximately $60 billion, the company was valued at over 20 times its forward revenues. For comparison, Cisco Systems, the poster child of the 2000 tech bubble, peaked at around 30 to 40 times sales and 200+ times earnings during the dot-com frenzy. Cisco's stock subsequently crashed 86% when the bubble burst. Bears point out that Nvidia, circa 2023 to 25, looks eerily similar to Cisco, circa 1999 to 2000 in terms of hype and valuation. Both were dominant in their niches, Cisco in internet hardware, Nvidia in AI hardware. Both saw revenues surge by an order of magnitude, and both became the world's most valuable companies briefly on the back of transformative tech narratives. To skeptics, Nvidia's valuation assumes flawless execution and endless growth. Any hiccup, whether a slowdown in AI spending, a new competitor, or geopolitical issue, could break the spell. We already saw a preview of this volatility. In early 2024, Nvidia shocked the market with an underwhelming outlook, causing its stock to plunge 9.5% in one day and erasing $279 billion in value. That was the largest single-day loss of market cap for any US company ever, even exceeding Facebook's record plunge in 2022. What triggered it? Simply put, Nvidia's guidance, while strong, wasn't high enough to satisfy the market's lofty expectations. When a company is priced for perfection, anything less than spectacular can send investors running. This episode illustrates how fragile the narrative can be. Nvidia didn't suddenly lose its technological edge or customers. It merely hinted that growth might not continue accelerating at an astronomical rate. The stock's extreme reaction signaled that sentiment, not just fundamentals, is driving the bus. Another concern is the sustainability of demand. Yes, generative AI sparked a gold rush for GPUs in 2023 to 2024. But will that level of spending persist? Bears point to past mini-bubbles in Nvidia's own history. For example, during the 2017 crypto craze, Nvidia saw a huge spike in GPU sales for cryptocurrency mining, only to suffer a sharp revenue drop in 2018 when the crypto market collapsed. The company was left with excess inventory and had to slash prices. Its stock tumbled nearly 50% from late 2018 into 2019 as reality caught up. While the AI boom is broader and more substantive than crypto, skeptics warn that current demand could be front-loaded or over-ordered. If every cloud provider and enterprise has now bought plenty of AI hardware, future growth might moderate. There are only so many $10 to $20 billion GPU clusters the world will build before ROI expectations kick in. Already, some reports indicate that by mid-2025, the frantic pace of orders could stabilize as supply catches up and buyers digest their new AI capacity. Wall Street's growth forecasts for Nvidia, which imply years of double or triple-digit growth, could prove overly optimistic if AI investment cycles follow a typical S-curve, rapid adoption followed by saturation. Crucially, competition is on the horizon, an area where Cisco's cautionary tale is instructive. Cisco thrived in the 90s partly because many upstart internet companies bought its gear with venture capital money. When the funding dried up, so did some of Cisco's growth, and rivals also entered the fray. For Nvidia, the competitive landscape is evolving fast. In the short term, no single chip competitor can match Nvidia's performance or ecosystem. AMD, for instance, holds only a single-digit share of the AI accelerator market. But long-term bears see threats multiplying. The largest customers, Google, Amazon, Microsoft, are developing their own AI chips to reduce reliance on Nvidia. Google's Tensor Processing Units, TPUs, have already been used for its internal AI like AlphaGo. Amazon's AWS offers Inferentia and Trainium chips for certain AI workloads. These in-house ASICs can undercut Nvidia's prices or optimize for specific tasks. While they haven't dethroned GPUs yet, each generation improves. If hyperscalers succeed in a good enough alternative, Nvidia's growth with these key accounts could stall. Startups and new architectures. Dozens of startups, Graphcore, Cerebras, Habana Labs before Intel acquired it, etc., have tried to build a better AI accelerator. So far, none have made a dent in Nvidia's lead. However, the AI boom has attracted massive capital into this space. A breakthrough architecture, say, chips specialized for transformer models, could emerge. Even if a startup doesn't beat Nvidia outright, competition can pressure Nvidia's pricing. Nvidia's current margins assume it can charge premium prices. An overly crowded field could spark a price war or lower-cost alternatives. Alternative approaches. Some skeptics speculate that the future of AI might not require Nvidia's gargantuan chips for every task. For instance, advances in model efficiency could allow smaller models to do useful work on cheaper hardware. If software innovation reduces the need for brute force GPU computing through optimized algorithms or model compression, demand for top-tier Nvidia chips could slow. An extreme scenario played out in early 2025. A Chinese startup called DeepSeek reportedly developed an AI model that rivaled OpenAI's GPT, but with far less computing power. That news contributed to a panic selling of Nvidia, as investors feared a potential paradigm shift. While that may have been an overreaction, it underscores how the narrative can flip if the necessity of Nvidia's hardware is questioned. Then there's the geopolitical risk, which is impossible to ignore given Nvidia's dependence on global supply chains and markets. Nvidia is fabless, meaning it outsources chip manufacturing to foundries, primarily TSMC in Taiwan. Taiwan's geopolitical precariousness, sitting under the shadow of potential conflict with China, represents a serious risk. If, say, a Taiwan crisis were to disrupt TSMC's operations, Nvidia's supply of advanced chips, like H100 and beyond, could be cut off for an indefinite period. Even short of a worst-case scenario, there are real issues: capacity constraints and export restrictions. The US government has imposed export bans on selling Nvidia's highest-end chips, H100, and a specially nerfed version called A800, to China. China has historically been a huge market for Nvidia, accounting for approximately 17% of its revenue in 2023, especially for data center and cloud uses. In late 2022, US rules tightened, effectively banning Nvidia's state-of-the-art AI chips from China to prevent military use. Nvidia responded by creating slightly downgraded models for China, but in 2023, the US raised restrictions again, and even those workarounds, like the H20 chip, became subject to licenses. This has two effects. It spurs Chinese firms to seek alternatives, as we'll discuss, and it could cap Nvidia's accessible market. If geopolitical tensions worsen, Nvidia might lose access to China's enormous tech sector entirely, or conversely, lose access to TSMC's bleeding-edge fabs if conflict erupts. Bulls might argue these are low-probability scenarios, but bears contend that Nvidia's valuation leaves no room for such risks. When you're valued at over $1 trillion, you need everything to go right. The world doesn't always cooperate. Meanwhile, Chinese competition is mounting by necessity. Huawei, the Chinese tech giant, has unveiled its own AI chips, like the Ascend series, and in 2025 began mass shipment of the 910C GPU, a domestic alternative aimed at Nvidia's level. According to Reuters, Huawei's 910C was designed to achieve performance comparable to Nvidia's H100 by packaging two chips together. Chinese AI firms, cut off from top Nvidia silicon, are likely to make the 910C their go-to choice. Alongside Huawei, several Chinese startups, More Threads, Byron, Iluvatar, and others, are racing to fill the Nvidia gap in China. No one expects these domestic chips to surpass Nvidia overnight. However, this homegrown push means Nvidia may never regain its previous footing in the huge Chinese market. Over time, that's potentially tens of billions in lost opportunity. The export bans also have a perverse effect. They give foreign competitors and would-be competitors a strategic window to catch up technologically without direct competition from Nvidia's best. Jensen Huang himself lamented that US restrictions are an ongoing threat that motivate China to accelerate its own chip development. In short, geopolitical currents could erode Nvidia's dominance at the margins, even if the company remains strong at the core. Finally, consider the basic law of large numbers. Nvidia's market cap, as of mid-2025, touched an astonishing $4 trillion, making it the most valuable company on the planet, even above Apple. At such a scale, to keep doubling your value, you need to unlock trillions in new market opportunities. Bulls say AI is that big, perhaps multi-trillions of dollars of impact, but bears question how much of that Nvidia can really capture. The company's own revenue, while growing fast, is still low compared to its market value. When Nvidia hits $130 billion in annual sales, a feat only a few tech firms have achieved, even then, a $4.68 trillion valuation implies an approximately 36 times price-to-sales ratio. If sales one day reach $200 billion, more than 3 times Intel's or IBM's current revenues, a $4.6 trillion valuation is about 23 times sales. In all cases, the stock's price today is banking on a future that is extraordinary. Any scenario where Nvidia's growth slows, perhaps because the AI investment boom normalizes, or competition slices some share, or margins compress, would force a harsh reassessment of that future. And history shows that when market darlings fail to meet hyperlinear growth expectations, their stocks can correct severely, as Cisco, Microsoft, and others did in the early 2000s. Overpaying for growth, even real growth, can be a bad investment, as Cisco's .com saga demonstrated. For students of market history, Nvidia's ascent rings a few bells, the loudest being Cisco systems in the late 1990s. Cisco was the Nvidia of its day in many respects. It was a plumbing provider for a transformative tech trend, the Internet, much as Nvidia provides the digital plumbing for AI. During the .com boom, Cisco's revenue exploded 850% between 1995 and 2000, from approximately $2 billion to $23 billion, fueled by massive spending on networking gear to build out the web. Nvidia's growth, while not identical, mirrors this kind of trajectory. From approximately $4 billion revenue in 2015 to over $60 billion in 2023, a similarly jaw-dropping increase. Cisco's stock price grew even more wildly, rising 3,800% in 5 years, and peaking in March 2000 with a market cap above $500 billion. It became the world's most valuable company at that peak, with a title in its annual report urging investors to capture the momentum. Replace Internet with AI and momentum with today's buzzwords, and it sounds familiar. In 2023 to 25, Nvidia's stock likewise more than doubled within a year and gained roughly 700% over 5 years, vaulting it into the trillion-dollar club. Both companies had charismatic CEOs evangelizing a new era of computing. Cisco's John Chambers was telling anyone who'd listen in 1999 that the Internet would change everything, just as Jensen Huang proclaims the epical significance of AI today. At their peaks, valuations also bore a resemblance. Cisco traded at over 200 times earnings and nearly 40 times sales at the height of the dot-com optimism. Nvidia hit around 110 times earnings and 35 plus times sales at points in 2023. These are not exact matches, but they're in the same ballpark, essentially extreme by any traditional yardstick. The justification, then and now, was rampant optimism about future growth and a sense that the company was indispensable to the revolution underway. In Cisco's case, the revolution, internet usage, did continue to grow massively, yet Cisco's stock did not. When the bubble burst in 2000 to 2001, Cisco's share price collapsed by 86%, from a peak of $79 to about $9 2 years later. And here's the sobering part. Cisco's business didn't collapse proportionally. Its revenues dipped only slightly, from $19 billion in 2000 to $18 to $22 billion in the years after. In fact, Cisco kept growing sales in the ensuing decades, more than doubling sales from 2000 to 2022, hitting $52 billion in annual revenue. Yet Cisco's stock never again reached its 2000 high in nominal terms. Even 20 years later, in 2021, it briefly got close, but then fell back. On a total return, with dividends basis, it took 2 decades for long-term investors just to break even. Why? Because the valuation that investors were willing to pay in 2000, the hype premium, evaporated and never returned. Cisco went from a high-flying growth stock to a stable, respectable company. But the magic was gone. Early investors who captured the momentum and didn't sell endured a very long and painful winter. What lessons from Cisco might apply to Nvidia? The key one is that a great company is not the same as a great investment if bought at an inflated price. Cisco was, by all accounts, a well-managed leading firm with real profits and an important role in the internet age. Likewise, Nvidia is a superb company at the center of AI. But as Cisco's story shows, you can overpay even for the best companies. When Cisco was trading at 40 times sales, it was simply unrealistic to expect its future growth to reward shareholders at that entry price. Similarly, skeptics say Nvidia's stock at 30 times or 40 times sales has priced in a scenario where everything goes right for the next decade or more. If the company merely does well, as opposed to miraculously, the stock could languish or decline. History is littered with stocks that had world-beating runs and then took years or decades to recover once the narrative cooled. The dot-com era offers multiple analogies. Microsoft's stock peaked in 2000 and didn't sustainably break that level until approximately 2016, despite Microsoft's earnings tripling in the interim. Amazon had a 90% crash in 2000 and took years to recover, though it eventually did spectacularly. Cisco never regained its former glory in stock terms. The cautionary pattern is that being too early or too optimistic in extrapolating a trend can lead to poor returns, even if the trend itself, like the spread of the internet or AI adoption, proves very real. That said, some argue that Nvidia is not exactly Cisco and that this analogy can be misleading. For one, Nvidia's current customers, cloud providers, enterprise AI labs, governments, are generally deep-pocketed and here to stay. Cisco's growth in the late 90s, on the other hand, was heavily fueled by fledgling dot-com startups spending venture capital. When many of those startups failed in the 2000 crash, a chunk of Cisco's demand vanished overnight. Nvidia's demand base might be more durable. Microsoft, Google, Amazon, and Meta are unlikely to disappear, and they will likely continue investing in AI for years, albeit with some cycles. Additionally, Nvidia is already much more profitable as a business than Cisco was at its peak. By 2025, Nvidia's forward price-to-earnings ratio had moderated to around 25 to 30, according to some estimates, because its earnings exploded with the surge in AI chip sales. Cisco's forward PE in 2000 was north of 100. This suggests Nvidia's valuation, while high, isn't as outright absurd relative to its near-term earnings power as Cisco's was. Furthermore, bulls contend that AI's impact may be broader and more sustained than the first internet boom. The comparison might instead be to the rise of cloud computing in the 2010s, a secular trend that produced multi-trillion-dollar giants without a 2000-style collapse. In fact, one analysis noted that much of Nvidia's AI revenue comes from established companies' budgets, not frothy startups, which could mean demand is less likely to evaporate suddenly. In the late 90s, Cisco's fate was tied to customers that ultimately couldn't pay the bills. In the 2020s, Nvidia's customers are Fortune 500 firms and governments with strategic reasons to keep spending on AI. So, is Nvidia the next Cisco? The answer may be yes in terms of investor enthusiasm and valuation extremes, but not necessarily in terms of outcome. The analogy highlights the risk of over-exuberance, a reminder that even dominant tech firms can see their stock prices deflate dramatically when hype cools. However, Nvidia's supporters would say the company learned from history and positioned itself more prudently. Only time will tell which interpretation holds true. But the very fact that serious commentators draw this parallel shows that Nvidia's trajectory is entering a zone historically associated with bubbles.